this morning, and will be made available pretty early afterwards. I wanted to tell you more about what's going on here at Insurance Agency Marketing, kind of give you some updates on what's current and what we're offering our producers, and then like I said, we'll turn this over to Casey in a moment. So first, I want to talk a little about our new producer bonus. Very happy to talk about something where we're helping you receive more dollars for your production, and as our way of saying thank you for placing business with us in your first 180 days at Insurance Agency Marketing. We have different levels of production that you can obtain and be rewarded for doing so. So as you see on the screen here, we have several different items that we can reward you with. Of course, we see a lot of agents taking advantage of the cash option, but that's entirely up to you. And so if you are new or will be newly working with us on your single premium life, your fixed index business, this is something you have to look forward to as a way of, again, rewarding you and saying thank you. Recently, I did do some research on our competitors, and I did not find another company that offers a new producer bonus. Now, there may be some other incentives that they offer, but in the form of cash, for example, that's kind of hard to find. So that is our new producer bonus, an ongoing program here at IMES. We do have our Boulders Resort and Spa top producers trip. We're currently in the midst of the qualification. As you can see at the very bottom of that, that started last July, and that runs through the end of this year. So it's an 18-month qualification. And you can also see towards the bottom the combination of business that will get you to Scottsdale, Arizona in February of next year. So if annuity business is your primary focus, $2 million of annuity premium, any carrier, any products count towards that production. If you're an individual writing some single premium life and annuity, it will be a combination of that business. So last year was, or the last trip for this was well attended. I believe we had around 70 agents or more that qualified for Victoria. And the way things are pacing now, this is looking to be an even more well-attended trip. So let us know how you can get there. We do send out updates on where you're at each month on the business. And if you're in the midst of qualification, you want to know where you're at, please let myself know, or any of the life annuity marketers would be glad to help you pace for that fantastic trip. Okay, our creative department has been very busy lately. We've been getting a lot of requests lately for email newsletters, I know. And if you do need some assistance in that area, for example, you want to visit with Josh or Tasia. They can talk to you about what they can offer for you as far as marketing and branding. They also get, I know, requests for, because we receive lots of requests for ways to improve websites. So if you're looking at, it's almost mid-year now in 2017, and if you hadn't done anything towards this, and it's not too late. So if you have a website now, you'd like to improve on it, or if you've not done that before, visit with either of them, and they'd be glad to give you an idea of what they can do and what kind of cost is involved with that. Okay, and again, I mentioned email newsletters. At the top, you can see that statistic there. 86% of internet users age 65 and older are using email. So this is a way to reach out. Certainly, a lot of people get a lot of emails. I think we all do. So, the way to do that is to make it, fresh, make it something that will catch their attention. And again, Josh and Tasia would be glad to visit with you about some ideas, and they could also send you some samples so you can get, kind of a direction of what you want to do. We just finished our last Life and Annuity Academy, by the way, 2 weeks ago. This was the first one of the year. Our next one is scheduled for September 6th through the 8th. If you are currently an annuity or life producer and you want to grow that business, you might want to consider our Life and Annuity Academy. Now, again, the next one is September 6th through the 8th. We know that date, and that will be here in Omaha, West Omaha, at our new brokerage office. And we are accepting registrations for that. So if you're interested in that, please let me know. Or any of your, if you have a marketer that you work with, we'd be glad to discuss with you more about it. After the webinar is over, we do have an email that will go out. Usually Sarah sends out an email regarding our Life and Annuity Academy. And so again, it's a 2-day training. It does cover a number of topics. We update it every time. Lately, of course, I know there's been a lot of interest in the DOL. Also, we have been promoting, as we now are full force with IAMS Wealth Management. And so, again, ways to grow your business. Talk to some top producers about ways to grow the business through perhaps seminar selling or other ways. We do updates on what's competitive with the carriers, including Athene. The last academy was held at Athene's home office, and we will, like I said, we have the next one in Omaha, and then there'll be another date in early November. I don't know that by heart, but I know we have an early November date, and I believe that will also be in Des Moines. So I'm going to launch a poll question right now. If you'd be interested in getting more information about the Academy. Again, if you're new to the business or if you're new to selling annuities, for example, this may not be the training for you now. Perhaps working with us for a while, getting some business into the brokerage and growing that some. We've had a number of people who were not active in the business, maybe started again in those markets, and then were invited later. So again, writing business is, of course, always a plus. So again, if you have any questions, would like to know more, we are taking registrations. We'll be glad to review it. And I think it's a great way to take your business to another level. This last academy, we had 35 agents at that. And the feedback I got from those that attended was that it was one of the best trainings groups that we've had to date. And IAMS has held the program now for approximately 8 years. So I'll be closing this out in a minute. Please respond if you'd like to get more information, or there'll be a registration. It'll have a sample agenda included with that. So we appreciate your interest in responding to that question. Okay, the paperless contracting. Moving on here, so I can get Casey to take over. We have seen our contracting convenience to our agents has really improved using the paperless contracting. So what is that? Well, you fill out the information, the data. You all know you've done contracting before. Fill out the background questions, and for approximately 90% of our carriers, that contracting can be used to get appointed with any of those. So you want to get appointed with a life carrier, annuity carrier. Down the road, you want to add a carrier to, like North American, and I know North American's on this program too. You just tell myself, one of the other marketers, or Chris, just shoot him an email and confirm that you want to add a new carrier. You don't have to fill out any more paperwork. So this has really helped us, and it helps the producers streamline getting appointed with new carriers. Our website has some great tools. If you've not been on our website, it's www.iamsinc.com. That's IAMSINC.com. Right before the webinar this morning, I was out there searching for a product for an agent. We use it a lot in the annuity department to quote income riders, also to search for products with particular parameters, maybe age or a bonus. I know in the life end of things, there's some great, or there's a great ability to quote for term and UL. You can quote UL in there, and you can do that at your convenience and your pace. I've used it, and it's very good. It does search for a lot of good quotes, top products, and it'll tell you underwriting requirements for life. You also have our rate book available, which is right now up to about 40 pages of data on our top carriers and top products, including income riders. And of course, our webinar schedule, for example, is on there too. So if you've not been on our website, take advantage of that. It is in the signature line of all of our emails too. So if you don't have that written down, you'll be able to find it from one of our emails. Okay, moving on, IAMS Wealth Management, I mentioned that before. Charles Hiring Jr. and his team are working hard to grow the business. We have already seen some incredible growth in this particular division of IAMS and in just the last few months. So one of the ways to work and grow your business and be in compliance, so to speak, with the DOL is to work as an advisor and obtain your Series 65. So if you'd like to get more information about how that can help you grow your business from those individuals that we've visited with that have worked in this market, it has helped them grow their business both as an advisor, but also as an insurance professional. You're reaching out to younger people. You're reaching out to a type of clientele that you did not have access to before, or maybe did not approach before. And of course, it's an ongoing revenue. So if you'd like to know more, get a phone call, or perhaps have some general information about IAMS Wealth Management sent to you, we'll pass that on to Charles, and he'll reach out to you. So this certainly is a direction that a lot of producers are going, even in light of, or even if the DOL rule and the DOL ruling January of next year does not go through. We're going to continue to grow in that market. So if you'd like to get more, have a question, just get some information, let us know, and we'll be glad to get this out for you. And we appreciate your response to that. Okay, a couple more slides here. Retirement Analyzer is a very comprehensive program to help producers with really learning more about their clients' needs and current assets. It is a planning software developed by agents for agents. And if you'd like to get something on that, let me know. Marcus Solar has had several webinars on this. He understands what's involved a lot more than I do. But I know we've had agents use this program over the years, and he can tell you a little bit more about the cost that's involved. But if you're interested in that, let us know. It is like I said, it's a very comprehensive planning tool that can help you in your business. Referred producer money and marketing reimbursement. Again, going back to our first slide, which was new producer bonus. These are some other ways that we put money in your pocket. If you're a producer and no other producers that you'd like to send our way, please let us know. We'll be glad to follow up with them, and we will reward you for that. Also, our marketing reimbursement program continues to grow. So as you continue to write business, dollars get thrown into the marketing account, and then for you to get reimbursement down the road, whether it be for E&O or a lead program, perhaps a seminar program. Anything that you have as a business expense can be used from that marketing reimbursement account. And the nice thing is it doesn't expire at the end of the year, for example. So you can continue to grow that for a time and then use it for perhaps a bigger purchase. So I appreciate your time, and now I want to turn over to Casey Lane at North American so he can tell you more about his presentation this morning. Casey?
Thank you very much, Jim. Appreciate that introduction. Let me just confirm. I want to make sure we get everything up and running here. Are we on my screen there, Jim, by chance?
Yes, I can see it. Yes.
Awesome. Excellent. Well, thanks again, Jim, for the introduction. And folks, on behalf of myself and all of the other employee owners here at the North American Annuity Division, thank you for taking time out of your busy schedules to join us on our webinar today. Obviously, as independent agents that work on commissions, you folks aren't making money unless you're in front of clients and prospects. So for you to take 45 minutes, an hour out of your busy schedule and away from those clients and prospects is certainly very much appreciated. Jim and Insurance Agency Marketing, thank you guys for giving me an opportunity to be on our webinar today. More importantly, thank you for being a true partner with North American Annuities. Now, what I'd like to do to start off is I like to start typically this presentation with a question, and it works a little better when I'm in front of a live audience, but I'm gonna start with this question anyway. By a show of hands or a nod of your head, how many of you, without any shadow of a doubt, know exactly and precisely how and when every single one of your annuity policyholders is going to use their annuity contract 2 years, 12 years, or 22 years down the road? You know, there's always one in the audience. I always have somebody raise their hand. You know, a better question is, how many of your clients know exactly and precisely how and when they're going to use that annuity that they bought from you 2 years, 12 years, or 22 years ago? They don't, right? Here's a common situation. You know, I do travel a lot. I talk to a lot of agents like yourselves in the field. Common situation is you're sitting across the table from a couple. You're doing a policy anniversary review, and the wife stops you mid-presentation and says, you know, Mrs. Agent, this annuity thing that we bought from you 5 years ago, well, what if we decide we don't want to use it for income for ourselves? We just want to leave it for the kids. Or probably the opposite happens more than that, and that is, you know, what if we decide we don't want to just leave it for the kids? We'd rather use it for income for ourselves. Bottom line is, do clients have a tendency to change their minds over the course of time? Yes, they do, and more often than not, it's more than once. It's probably multiple times over their retirement years that they change their minds. Well, what if, and no pun intended here, but what if, no matter where retirement takes your client, 2 years, 12 years, 22 years down the road, no matter how many of those what if questions they come to you with, and no matter how many times they change their mind over the course of retirement, what if there was a single solution you could provide them that would answer most, if not all, of those what if questions? Would that be something you'd be interested in learning a little bit more about? And I'm hoping you're all shaking your heads yes, because that's exactly what we're going to do today. We're going to talk to you about the BenefitSolutions Index Annuity, the what if product from North American. And before I get into my presentation, our compliance team wanted to say hello here for you, or to you. I think they may have actually more slides than I do. If they happen to call you, we went through both of their slides verbatim, word for word. Okay, so I get the common question, Casey, who's a prospect for the BenefitSolutions product? Who should I be talking to about this product? So the one piece of homework I have for you for the rest of my presentation is I want you to be thinking in the back of your mind about your database of clients and prospects. And the 5 bullet points you see here on the screen are probably the, I like to call kind of the sweet spots of this product and who you should be approaching and talking to about the BenefitSolutions product. And we'll go through, I think, 3 of them in more detail here in the presentation. But thinking of your database of clients and prospects, who comes to mind that needs or wants income now? All right, they're 65, they retired, they want to roll that 401k over, they're ready to start taking an income stream. You're going to find the BenefitSolutions is one of the strongest, if not the strongest, income now product on the market. What about that client that has this asset that they want to use for themselves a little bit, they want to take some income from it, but at the same time, they also want to leave as much of a legacy to their beneficiaries as they can? They're going to be a good prospect for the BenefitSolutions. I know you all have a client or multiple clients that are concerned about long-term care or nursing home confinement. If you do, we'll share with you how the BenefitSolutions product can benefit them. What about a client that maybe has just another safe investment, a CD, a money market account, just sitting on the sidelines that they've kind of tagged as that do not touch money. I am just leaving this for my beneficiaries, the kids, the grandkids, church, whatever it may be. If you've got clients that have assets just earmarked as wealth transfer, this is a wonderful standalone wealth transfer vehicle, and we'll show you how that applies. And lastly, and I'll share a sales idea with it on this at the end, who do you have that has qualified money and is currently taking those required minimum distributions and absolutely hates taking those required minimum distributions, right? They'd rather just leave that money sitting there and just leave it for the kids or grandkids. I'll share a strategy with you on how powerful the BenefitSolutions product is for that particular client as well. So again, thinking about these folks as we go through the presentation, my goal hopefully is you each have 2, 3, 4 names of clients or prospects that you can pick up the phone and talk to about the BenefitSolutions. So kind of like an income rider. I'm sure most of you have sold an income rider out there in the past on an index or variable annuity. So kind of like an index rider or an income rider, the BenefitSolutions actually has 2 separate values that we're going to be calculating at any one time. There's an accumulation value, and then there's a benefit base value. Now, the benefit base value is composed of 3 key features, not just income. There's 3 key features that are comprised of or a part of the benefit base value. The first one, and we'll talk about each of these 3 here in more detail. The first one is lifetime income. Guaranteed lifetime income is available from the benefit base value, and we'll talk about more how that works in a bit. For that client that says, well, what if I go into a nursing home or long-term care facility? Know that this product can provide benefits if the client is confined to a nursing home or long-term care facility, and also know that this product via the benefit base value does provide an enhanced death benefit value. And it's not one or the other on this, folks. I want to make sure we're clear. All 3 of these benefits are available as a part of that benefit base value. So what I want to do now, get under the hood a little bit here, look at the mechanics of how this benefit base value can grow. So again, we're going to be looking at the benefit base value and how this thing can grow. And I'm sure, again, most of you that have sold income riders in the past know that they typically roll up by a 5, 6, 7% roll up each year for 10 years or 15 years or whatever it might be. We all have our own different income riders. So know that the BenefitSolutions product is based on strong guarantees, although it works a little bit different than your typical income rider does. So here's the guarantees on the BenefitSolutions product. Day 1, that client's benefit base value will equal 120% of the premium the client put in the contract. So Mrs. Client, if you give North American $100,000, your benefit base value day 1 is $120,000. Now note that there's no bonus to the accumulation value side, okay? That is only on the benefit base value. So just real quick, and I'll talk more in detail here in a bit. Remember when I mentioned the first bullet point that this is a strong product for income now, right there for that, because of that 20% bonus day 1. That is why this product is so strong in that income now market space. Mrs. Client, worst case scenario, if after 5 years, and we'll talk about good case scenario here in just a little bit, but worst case scenario, if your benefit base value has not grown to equal 140% of what you put in after the 5th year, North American will guarantee that they will bump that benefit base value up to, in this example, $140,000. And worst case scenario, Mrs. Client, if at the end of the 10th year, that benefit base value has not grown to equal 160% of what you put in, again, North American at that point will bump that benefit base value up to equal, in your example, $160,000. So know, Mrs. Client, that worst case scenario, we have these guarantees built in. Again, although not your typical annual type of a roll-up, you can still look a client in the eye and tell them what their worst case values will be at those points in time. So a quick screenshot of an illustration here to show you the 120, 140, 160. We've got a 55-year-old client that puts $250,000 of premium in, You can see, Mrs. Client, day one, North American guarantees that benefit base will equal 120% or 300,000. Worst case scenario at the end of the 5th year, that will equal 140% or 350,000. And at the end of the 10th year, worst case scenario, that benefit base value will equal 160% or $400,000. Now, more than likely, kind of to getting back to the what if scenarios, your client's going to ask, well, what if, my account value, the strategies we use, what if there's, growth there based on those crediting things we talked about? Can my benefit base value grow by that as well? And how does that work? The answer is yes. We contractually guarantee for 20 years, 100% of any interest that's credited to your accumulation value is quote unquote stacked or added onto your benefit base value. So this is what we would call, or you would call, a stacking benefit or a participating benefit. So Mrs. Client, if based on the strategies that we have your premiums allocated to, you receive a 5% interest credit to your account value, your benefit base value that year will also go up by 5%. If it goes up by 3% next year, your benefit base value goes up by 3%. That is contractually guaranteed for 20 years. And I want to make sure we're clear that it is guaranteed for 20 years. And by that, I mean, even if the client takes a penalty-free withdrawal, even if the client's taking RMDs, even if they happen to trigger income year 1, year 8, whatever, we will still contractually guarantee those interest credits from the account value stacked onto your benefit base value. They're just reduced proportionately. And I'm gonna show you how this works. We kind of call it the replenishing effect. I want to make sure we understand exactly how that works. But here on your screen, again, you can see now, we're not looking at the guaranteed side, we're looking at a most recent 10-year scenario. And for time purposes, I want to let you know that this particular screenshot is showing an allocation into a strategy. It's a volatility control, an S&P 500 volatility control strategy, where we don't apply a traditional cap. So this is what you would call one of those quote unquote uncapped strategies. So Mrs. Client, as you can see here, here's your $250,000 of premium, your benefit base value day one, again, 120% or 300,000. At the end of the first year, man, we had a nice interest credit of 12.92% to your account value. Guess what, Mrs. Client? Your benefit base value of 300,000, not your premium of 250, but your benefit base value of 300,000 also increases by 12.92%. Next year, a 1.92% interest credit, your benefit base value goes up 1.92%. Well, here in the third year, unfortunately, the market was down, so there's no interest credit. You can see your benefit base value doesn't decrease. You can't lose money due to negative market performance, right? Next year, 7.15%, your benefit base value goes up by 7.15. Again, we contractually guarantee the stacking of these interest credits for 20 years, even in years where you are taking a withdrawal or have even triggered income. Because I want to make sure I'm real clear on that, because most income riders that you see, once you trigger that income, that's it. I mean, all you're going to receive is the accumulation value as a lump sum or as a death benefit feature. So remember earlier when I mentioned one of the bullet points on who's a prospect, and that's for that client that wants to maybe take some income for themselves, but at the same time they want to leave as much of a legacy. So even when you trigger income, you still have the opportunity, because of these interest stacking for 20 years, to pass on an enhanced death benefit value. Just because you've triggered income doesn't mean you lose the opportunity for that enhanced death benefit value. And again, we call this the replenishing effect. Well, technically, Casey calls it the replenishing effect. You will not see it referred to this in the brochure or any materials. Unfortunately, we do not do a good enough job of promoting this particular feature. So here's our 55-year-old client with that $250,000 deposit. And we're going to assume at the end of the 4th year, for whatever reason, they start taking a 3% penalty-free withdrawal. Now, I know it shows a dollar amount here on the screen, but on your input screen, you would put a percentage. So maybe they want to pay for a grandkid's college education for 4 years. Whatever the reason, they take 3% of the account value every year for 4 years in a row. So Mrs. Client, you take 3% from your account value. Guess what that means your benefit base value is going to do? It's also going to go down by 3%. However, Mrs. Client, as you can see, that first year you took that 3% withdrawal, there was a 3.53% interest credit. So because of this replenishing effect and that interest stacking, you actually get a net, basically 0.53% interest credit to your benefit base value. You're going to see that go up a little bit. Next year you take that 3%. Yeah, we had a 1.59% interest credit. So although it's not going to go down by the full 3%, because of the replenishing, you're not going to see any growth that year. Next year, you take 3%. You actually got a 3.67% interest credit. Your benefit base value went up by a little bit. And look at that. The next year, you took that 3% withdrawal. Your benefit base went down by 3, but we actually credited a 10% interest. So you're going to see a net growth really of about 7% to your benefit base value. Again, we contractually guarantee this for 20 years. Simply any withdrawal reduces the benefit base value proportionately, but with this replenishing effect, you still can see that benefit base value potentially growing because of that replenishing effect. So I hope I hit that pretty hard. Again, we don't do a good enough job promoting that in our brochures, but it is a unique and very strong feature of this product. So that's the benefit base value. We saw the guarantees, the 120, 140, 160 worst case scenario, and again, interest stacking from account value to benefit base value for 20 years. That's how our benefit base value can grow. So now let's talk about those 3 key benefits. And the first one, again, you're probably having conversations with your clients day in and day out about outliving their income in retirement. It is a big fear of a lot of clients and prospects. So know that the BenefitSolutions, one of the key benefits is guaranteed lifetime income. Now, one thing that we've done a little differently with this versus some of the other income riders that you're used to selling out there, we talked about the roll up on the front end, right? That your typical income rider grows by 5, 6, 7%. And then typically on the back end, what happens there? When the client says, hey, I'm ready to start taking income, start sending me a check. Typically what the insurance company does at that point in time is they apply a lifetime payout percentage to the income value. And that resulting number is the client's guaranteed lifetime income. Typically, it's a 5% payout percentage at 65. But let me ask you this. Do your clients really care about what the roll-up is on the front end, how long it's deferred, what's the payout percentage? No. What do your clients want to know? They simply want to know, what is my income going to be? I don't care how we get to it. I want to know, bottom line, what's my income going to be when I start triggering that at 62, 65, 68? So what we've done is we've made the explanation of how income is calculated on the BenefitSolutions as easy for the client to understand as possible. And what I mean by that is the income on the BenefitSolutions works very similarly to several programs that your clients are already used to, or they know about: Social Security and a pension or defined benefit plan. Your client knows that if I take Social Security at 62, it's going to be this less amount. If I wait till 65, I know it's going to go up to this amount. And if I wait till 70, it's going to go up even more to this amount. So the longer I wait, the higher that income goes. Same thing with a pension plan, defined benefit plan. Bob and Tom, they're both 65 years old. They've worked for the same employer. Bob started when he was 25. Tom started when he was 35. They both retire at 65. Who's going to have the higher lifetime income? Bob is, right? Because he's been in that defined, he's been with that employer for 10 years longer than Tom has. Even though they're both 65, Bob's lifetime income is going to be more because he's deferred that longer. That's how the income works with the BenefitSolutions. It is based on your age at the time the policy is issued and the length of time you defer it until you start triggering income. Just like Social Security, just like pension. The longer you wait, the higher that income is going to be. And I get the question a lot, well, Casey, how do you stack up compared to ABC company on a 65-year-old client that defers for, I can't tell you exactly how in every scenario we're going to stack up against every company, every other product out there. I can tell you that we're going to be very strong at the key retirement ages. And this product, when you talk about deferring less than or 3 years or less On a guarantee basis, this is going to be one of the strongest products out there in the market. And again, I'll show you a income now scenario. But again, Mrs. Client, just real quickly, let's take a look at on a guarantee worst case scenario. This is what your income is going to look like. You're 55, that $250,000, the premium you put in. If you want to take income immediately, you can, okay? You're going to get, based on your income or your benefit base of $300,000, your guaranteed lifetime income will be $10,920. But let's assume you want to wait 2 years. You hold it for 2 years, and in the third year you want to start taking income. Well, holy cow, your benefit base hasn't increased. It's still $300,000, but look at your income. It's now $11,550. Maybe you want to wait 4 years. Your benefit base hasn't increased, but look at that. Your income is now $12,330 because each year you defer it, that income increases. Every year you defer it, that income increases. So again, you can illustrate this. You can show the client, worst case scenario, here's what your guaranteed lifetime income is going to be. And I want you to remember, let's remember this $12,330 in the fourth year, okay? At the end of the fourth year, $12,330. Because, Mrs. Client, remember, this is worst case scenario, but we talked about, and you asked about, what if I have some gains, you know, does my benefit base grow as well? We already said, yes, contractually, we guarantee interest stacking to your benefit base value for 20 years. So let's take a look at this on a non-guaranteed basis. We know what you're going to get on a guarantee basis. On a non-guarantee basis, again, $250, there's your $300,000 benefit base. Here's our interest credits just stacking up, right? So basically what we're saying is we've got guaranteed income, Mrs. Client, but there's also the opportunity for potential maximum income as well. So if we compare the end of the fourth year here, right here, the benefit base value in that case is $369, basically $370. So now look at that, Mrs. Client. Instead of $12,330, your income's $15,200. Again, with that stacking of interest credits, your income, your guaranteed income, could increase to potential maximum income. So guaranteed and potential maximum income available with the BenefitSolutions. I do want to make one thing clear also. When you trigger income, let's assume you start taking income here and you get $15,200 a year. Remember, even though you've triggered income, you're still going to get that interest stacking for the remaining duration of the 20 years, just reduced proportionately. Once you trigger income, that is what your income is going to be. It will not change. Even if your benefit base value happens to grow at some point down the road over the next 17 or 16 years, whatever is left, your income is going to stay at $15,200. You have that benefit base value there as an enhanced death benefit to pass on. Triggering income, income is that for the rest of your life. Now remember, I mentioned income now, and folks, if you take anything from this presentation, just please remember this specific sweet spot of the BenefitSolutions. And I want you to remember this because this product you're not going to find on a lot of those industry income calculator type things out there. And I'm not sure honestly if it's on IMS or not. If it's an internal one that they use, I'm not sure if it's on there. So please, if you have a client that's 65 to 75 years old and wants to take income immediately, you can trigger income 30 days after issue on this thing. You're going to find we are, if we're not at the top, we are mere pennies from the top company when it comes to the income now market space. And you can see that on the screen there. $250,000 deposit, Mrs. 65-year-old client, North American's going to guarantee you $13,860 a year for the rest of your life. Yes, there is a company that does or will pay you $83 more a year, $7 a month on a $250,000 deposit, but I think you're going to probably prefer the financial strength and ratings of North American. And remember, Mrs. Client, even when you trigger income, even if you do it immediately, what does North American guarantee they're going to do for 20 years? That's right, they're going to stack that interest from the account value to the benefit base value, just reduced proportionately by your income. So again, folks, remember 65 to 75, income now, the BenefitSolutions. This is a huge sweet spot for this product. Now, as just a quick tidbit too, the only way you can show a client what their income is going to be with the BenefitSolutions product is you do have to run an illustration. you have to go out to our website and you have to run an illustration. But I don't think you're going to be too dissatisfied when you see the resulting numbers there. Okay, so that's the income side. Remember, there's 3 benefits. We also have for that client that asks you, because they will ask you, what if 5 years from now, what if 12 years from now, I am confined to a nursing home or long-term care facility? Can this product benefit me in any way, shape, or form? The answer is yes. The BenefitSolutions does provide a nursing home multiplier, or what is also known in the industry as the income doubler. So Mrs. Client, as long as the policy's been in force at least 2 years, all right, and as long as you are confined, it is a confinement feature, as long as you're confined for 90 consecutive days to a qualified care facility, North American contractually guarantees that the income you're receiving, or the income that you would be receiving if you haven't already triggered income, they will double that payment for a period of up to 5 policy years. Okay? Now, a couple things to make sure we're clear. Number one, this isn't, and I can never remember the exact termination. This isn't indemnification. It's not an indemnification feature, so the client doesn't have to use the income to pay the nursing home. We're not going to send the check to the nursing home. The check's going to the policy holder. They can do whatever they want with that money. More than likely, they're going to use it to pay the nursing home, but they don't have to. Also, if the account value does hit 0 during the confinement payout, that income doubler will stop and it will simply revert back to the original lifetime payment amount. Okay? Also, although it does show it here for 5 consecutive years, note that this is 5 years for the life of the policy, meaning, Mrs. Client, you may go into a nursing home and you may only be in there for a year and then you get out. Maybe it's, you had a hip, something went wrong with your hip, you had to go into the nursing home for a year, you get out. Well, you still have 4 years left of income doubler if you happen to go back in at some point down the road, okay? And if you've happened to chose joint lifetime income, the income doubler applies to either spouses. If either spouse is confined, or if one's confined and gets out and the other one goes in themselves, again, it's a total of 5 years for the life of the policy. And lastly, if joint income has been taken or chosen, it is still a true income doubler, meaning it's not going to be 1.5 times for a joint income. If your joint income is $20,000 and you go into the nursing home, it's going to be $40,000. It's going to still be a true income doubler. Now, I always get the question also, Casey, what kind of underwriting do they have to go through? There is no underwriting. This is not long-term care insurance. It's not meant to be a replacement for long-term care insurance. It's an alternative to long-term care insurance, because you know as well as I do, a lot of older clients can't get nursing home or long-term care insurance. They're not eligible for it. And if they are, a lot of them, unfortunately, probably can't or don't want to pay the premiums, which probably aren't going to be guaranteed for any length of time nowadays on long-term care insurance. It's a nice alternative for that feature, and it will answer that what-if question when the client asks you that. So that's the nursing home doubler. We got income and we got the income doubler. And lastly, that third benefit provided from the benefit base value is an enhanced death benefit feature. So typically, well, not typically, but as the beneficiary, they can choose at the time of death either a lump sum of the accumulation value, or as long as the policy is in the second contract year, so please don't write anybody on their deathbed. They cannot die in the first year. So as long as the policy's been in force at least a year, they can choose that that benefit base value, that higher benefit base value, over 5 equal payments. So account value, lump sum, or benefit base value over 5 equal payments. So quick example here, you can see this is a worst case scenario. Client deposits $100,000 and they die at the end of the 5th policy year, beginning of the 6th year. So remember, guaranteed day one, they had 120% benefit base value, 120,000, and worst case scenario at the end of the 5th year, that's going to bump up automatically to equal 140% or $140,000. So they die then. Beneficiaries can take that account value lump sum, or they can take that $140,000 over 5 equal payments of $28,000. Couple things to point out here. First of all, this is not life insurance. Okay, this is not income tax free. However, do know that each of these payments is a part return of premium and part interest. So we're not paying out all interest first and then cost basis. It's going to be somewhat of a exclusion, if you will, exclusion ratio. So part return of premium and part interest. So you are spreading that tax burden out over that 5-year period. Also, again, I mentioned this is not life insurance, so the client doesn't go through any underwriting. I mean, it's there. This is available. Doesn't matter how sick or not sick you are. And also, if there's multiple beneficiaries, they do have to elect the same option. So one of the kids can't say, hey, give me mine via the lump sum via the account value, and the other one say, well, I want my death benefit from the higher benefit base value. They have to be on the same page. And as owner of the policy, after the policy has been issued, the owner can complete a restricted beneficiary payout form, which will dictate exactly how they want each of the beneficiaries to receive those payments. So they can dictate 3 kids, you're all taking the benefit base value over 5 equal payments, or you're all going to take yours over the accumulation value. So they can dictate exactly how they want those beneficiaries to receive that death benefit. Now, remember I mentioned one of the bullet points was for that client that just has an asset they've earmarked as wealth transfer, they're not going to touch it. This is a great standalone death benefit product. I know you don't come across just a straight death benefit type of a need as much as maybe an income type need, but as a straight wealth transfer vehicle, this is a fabulous product because remember, for 20 years, we contractually guarantee those interest stacking from the account value to the benefit base value. So Mrs. Client, by the way, I didn't talk about issue ages and things. The 10-year BenefitSolutions product is a minimum issue age of 40, maximum issue age is 79, and the 14-year version, if you can sell that, minimum issue age 40, max issue age 75 in most states. So if you've got a 78-year-old that purchases the BenefitSolutions 10, guess what, Mrs. Client? You have the chance to see that death benefit grow for 20 years until you turn 98. It's not going to stop rolling up at age 85. It's not going to stop if it hits 2 times premiums paid. Your benefit base value will contractually grow for up to 20 years if you are still alive. Most other riders out there, most death benefit type features you see typically stop at a specific age, or once that value hits, again, 2 or 2.5 times premium paid, that value can't grow anymore. Not on the BenefitSolutions. If that benefit base value, because of those interest stacking, has grown to 5 times premiums paid, that's what the death benefit value is going to be. So again, remember this also as a great standalone wealth transfer vehicle. Okay, so we covered benefit base value, how it grows, guarantees, also with the stacking of interest. We looked at the 3 key features and how they work. Now you're probably all thinking, this is all great, Casey, and then we haven't even talked about there must be no fee on this thing. Unfortunately, we're an insurance company. As you know, nothing is free. So there is a cost. The cost is 1.2% per year from the client's accumulation value. So their account value will go down by 1.2% a year for the rest of their life. Okay, that's the cost for for those features. Also, I forgot to mention on the income doubler, that is not available in a few states. I know California it's not available. I think Washington or Oregon, that particular feature is not available. However, regardless of what state you're in, the product also has a 100% liquid nursing home waiver. So for that client, even in California that says, well, what if I go into a nursing home? Can this thing benefit me? Yes, it can. The 100% liquid nursing home waiver works kind of the same way as the doubler in that you have to be confined for 90 consecutive days. And if you do meet that qualification, you can access 100% of your account value, penalty-free, no surrender charges whatsoever. So you've got the doubler, or you've got the nursing home waiver, which again gives you 100% access to your accumulation value, penalty-free at any time. And then last kind of extra feature I like to talk about, I kind of call this a return of premium, a 10-year return of premium feature. I mean, the chances of this actually occurring are pretty slim, but it is a nice peace of mind for your policyholder. And how this works is if the client, after 10 years, has not taken a withdrawal from their contract, And if that accumulation value, for whatever reason, is less than what the client put in the contract, we guarantee that we will bump that account value up to equal the premium they put in the contract. So when you might see this happen, and it could happen, is in maybe a bear market. Maybe we have like we've had an 8-year bull run, maybe we have an 8-year bear market where the market's flat or negative 8 years in a row. Now remember, you can't lose money due to negative market performance, but if we're taking a 1.2% fee out every year for that from the accumulation value, there's a slight chance you could see at the end of 10 years that your accumulation value is less than what you put in. So Mrs. Klein, if you gave us $250,000 and you didn't take any withdrawals out for the first 10 years, and that accumulation value is less than $250,000, North American's going to guarantee they're going to bump that up to equal $250,000. And what that means, Mrs. Klein, is on the 10-year surrender charge contract, you can take that money, that full account value, that full premium that you put in, penalty free. So kind of, again, a return of premium feature after 10 years. And that will illustrate, you'll see that on the guarantee side of the illustrations as well. All right, I told you I was going to end with a sales idea. I got about 3 minutes left here. This is based on that last bullet point. And again, think about your database of clients and prospects and who comes to mind that has qualified monies and is at or near the required minimum distribution phase. And you know darn well that that client's going to hate taking those required minimum distributions, right? They'd rather just leave them in there for the beneficiaries. And here's a couple of reasons why. Let me just share a couple of some statistics, if you will, with you. The first two are more opportunities than anything. So currently there's $5.2 trillion in the market in qualified accounts. Now I'm sure all that $5.2 trillion isn't specifically in your neck of the woods, wherever you are at, Mr. or Mrs. Agent, but that's a huge opportunity to capture some qualified dollars for clients that are going to be in that RMD phase. As a matter of fact, today, currently there's 37 million households that are already in the required minimum distribution phase. I'm sure there's probably a couple of them in your neck of the woods or even in your database of clients and prospects. And you know why those folks hate taking those required minimum distributions? Because IRA owners typically have 8 times more investable assets than non-IRA owners, meaning they don't need the RMD. They don't need that extra income. They don't want that extra income. They'd rather leave it in there for the kids or grandkids, but Uncle Sam's knocking every year once you turn 70 and a half, right? So you have to take them even though you don't want to take them. And then this last bullet point, this is huge, and this has to do with that replenishing effect. And I'll show you exactly how powerful this is. At 70 and a half, the required minimum distribution withdrawal percentage is 3.5% of the client's account value. So when you take that first RMD out, Mrs. Klein, of 3.5% of your account value, what does that mean is going to happen to your benefit base value? It's also going to go down by 3.5%, right? But if you have a 5.5% interest credit that year, your net growth is going to be actually 2%. Your benefit base value is still going to grow by a net 2%. And even at age 83, the RMD withdrawal percentage is still only 6%. So when you take that 6% RMD out, your benefit base value goes down by 6. But if you happen to have interest or strategies where we don't apply those traditional caps, maybe you get a 7% interest credit. Your benefit base value that year will grow by a net 1% because of that replenishing effect. Remember, 20 years, we contractually guarantee that. So let's see exactly how powerful this product is in the RMD and legacy situation. So here's Helen. I know you all have a Helen in your database, right? Helen is 70 years old. She has $250,000. She knows she has to start taking RMD starting at 70 and a half, but she'd rather leave all of the money or as much as she can for her beneficiaries. She's going to put $250,000 into the BenefitSolutions. I apologize. This says BenefitSolutions 2, which is available in certain states, Washington, Oregon, Utah. For our purposes here, when we look at the guaranteed column, it doesn't matter if it's the BenefitSolutions 2, the BenefitSolutions 10, or the BenefitSolutions 14. It's going to be the same. So she puts that $250 in there. She starts taking required minimum distributions out after the first year. You can look Helen in the eyes, and you can tell Helen, after 10 years, so this is after the 10th year, you gave us $250,000. You've pulled out $77,000. This is worst case scenario. This is worst case scenario. The market's down for 10 years in a row. you pulled out $77,000. However, your benefit base value at that time is actually $266,000. It's more than what you put in. And Helen's probably going to look you in the eyes and say, well, how is that possible? I've taken $77,000 and my benefit base value actually grew in a worst case scenario. The answer, or why that happened, is you still get the 120, 140, 160 guarantee bumps. Remember, worst case scenario, those have just been reduced proportionately by those RMD withdrawals. But because those RMD withdrawals, those percentages are so low, it hasn't reduced that benefit base value to less than what they put in because of these bump ups. So Mrs. Client, Helen, you gave us 250, and total, you pulled out 77, and at the benefit base of 266, we're going to distribute a total of $343,000 to you, which you've taken already, and your beneficiaries, all on a $250,000 deposit in a worst case scenario. That is powerful. And you can illustrate that, Mrs. Client. Here you go. 250 after 10 years, you've taken $77,000 of RMDs out. And even after you've taken those RMDs out, you can see that your benefit base value is still $266,000. Again, RMDs and legacy, the BenefitSolutions is a strong product. So I'm going to end here. I'm going to keep the screen up for you for a few minutes. Again, think about your database of clients and prospects. Who comes to mind that fits one or maybe even several of those bullet points? And with that, Jim, I'm going to turn it back over to you. I don't know if there's questions or anything like that, or how you want to handle that, my friend.
Well, thank you. And I learned something on that last part about the RMD. That's a great sales point, a great selling point, I should say, for this product. I did want to ask you, or there was a question asked here about qualified, but I guess we answered that because when you were discussing the death benefit, you were saying a portion of that would be return of premium. But of course, if it's an IRA and they took that out, then it would all be taxable. But they'd be spreading the tax over 5 years. So a very unique combination. This week, I have had requests from producers for an income doubler due to confinement, and also on death benefit. And when you think about it, there are not very many products in the marketplace today that offer an income rider, a doubler, and a death benefit. It's very hard to find, because we get that request, and the players in that market are very few, and this is one of the best ones out there. So also, Casey, you were asking, you did ask a question, if the product comes up on comparisons. Yes, it does. And so on income payout, first year, for like income right away, I believe you call it, this product does show up a lot on our comparisons, the tool that we use to compare riders. So it is out there, and it does come up, and it is one of the best depending on the age, you know. So I did want to thank you again for your information today, and the presentation, Casey, was very informative. And if any of you would like to get more information about the BenefitSolutions, like to get more like on the product itself, maybe a brochure or the current rates or both, we'd be glad to get the information out for you after the webinar is over. So if you'd like anything there, if you have a question about that and or clarification, or would like to see an illustration, please let me know, or your annuity marketer here at IAMS, and we'd be glad to help you with that. Again, we've worked with North American for many years. I've worked with North American for many years in Casey Lane, and this is one of the best products I've seen in a long time that can help your clients with whatever needs they have. So thanks, Casey. We appreciate it so much.
Thank you, Jim.
And we will look forward to visiting with you again. We appreciate your information and your sales ideas, and I hope all of you have a great weekend coming up.